All right, hello everyone. Welcome to tonight's session webinar, CME Micro Treasury Yield Futures, Insight, Strategies, and Trading Dynamics. My name is Ayman Rosie, your host for tonight's session webinar. So, before we start, I will give a little introduction about Philip Capital. So for disclaimer, this presentation is only for educational purposes only. So before you make any investment decision, you may do a research first before you make any investment decision for your trading journey. So about Philip Capital, Philip Capital is incorporated on 7 October 1995, a subsidiary of Philip Capital Holdings Sdn Bhd, or you may know us before as Philip Futures Sdn Bhd. We are trading participant of Bursa Malaysia Derivative Berhad, participating organization of Bursa Malaysia Securities Berhad, and also we are the holder of Capital Market Service License. So today, Philip Capital has 11 offices across Malaysia, or we call it as Philip Investor Center. On the north, we have Alostar and also Penang. On the south, we have Johor and also Malacca. On the east coast, we have Kuantan. And at Klang Valley, we have Kota Damansara and our HQ located at the heart of Kuala Lumpur. And not to forget, Sabah Sarawak, we have Kota Kinabalu, Cebu, and also Kuching. And this is our global network, which means we have offices in 15 countries. So Philip Capital is not just a local player. So over the 50 years in the financial industry, we have expanded to 15 countries around the world. And this is our global coverage. We are not just have a Bursa Malaysia, but we have a product like in the US, we have a CME. In the Europe, we have a ICE and also Eurex. Hong Kong, we have Hong Kong Futures Exchange, and Singapore, we have Singapore Exchange. And Philip Capital is a proud Bursa, recipient of Bursa Excellence Award. And recently, we have won the Best Retail Derivative Trading Participant for 2024. So why Philip Capital is your one-stop solution for your trading? This is the list of our product. We have futures, equities of stock, and also CFD. So in futures, we have an index, agricultural, metal, energy, and interest rate. And for stocks, we cover Malaysia share, US, Hong Kong, Singapore, and also Australia. And for CFD trader, also you can have open an account with us because we offer Bursa share, NYSE, Nasdaq, US index, and also commodities. So why Philip Capital is your broker of choice? Because we is a award-winning multi-asset broker. As you can see in the previous slide, we are the recipient of Bursa Excellence Award, and we have 24 hours broking and execution support, which means from Monday to Friday for 24 hours, we have your support for your trading. And we also have an advisory service, which we have a personal coaching for those who want to know more about our product and also platform. We also give a latest market news and update. And we have a wide array of product. As you can see, we have a stocks, futures, and also CFD. And we have no platform fee when you open account and also trading with us. For the free one-to-one coaching, we divide it into two sessions. The first one is product knowledge, where we give introduction to futures, CFD, and also stock trading. And then the second session is a platform coaching, where we will familiarize with our in-house charting system. We also have a weekly market call. Every Monday, 11 a.m., we have a market view and also update. And every Monday, 8 p.m., we have a live counter technical analysis. So you can scan a screenshot or take photo of this QR code. It will bring you to our website. to know more about our upcoming seminar and also webinar. And bear in mind that our seminar and webinar is free of charge. So whether you are our client or you are someone new into trading, you can join us for free, no charges. And you can scan the QR code, and this will bring you to our website for online account opening. So you can just open your stock account and also futures account online. No need to come to our branch to open account. And I will show you for our trading platform that we use for our client. The first one is for futures client. We will use Philip Nova. So Philip Nova have over 90 technical indicators, buy sell directly from the chart. And if you want to know more about our platform Philip Nova, you can scan for the demo account and you will register. And this demo account will be live for 30 days only. And good news for TradingView subscriber. Now, Philinova is powered by TradingView. So you can link your TradingView with Philip Nova. So which means that you can trade through TradingView and no need to open Philip Nova. So you can use your indicator or coding in the TradingView and straight trade from TradingView. For our stock client, we will use Bones Global for desktop and also apps in phone where we can trade US, Hong Kong, and also Singapore, and of course Malaysia in just one apps. And it is a very user-friendly interface and easy to use. And if you wanted to trade a US share, now you can invest US share and ETF from only 0.02% or minimum 3.99 USD, and you will receive a US live market data. And for the for the CFD client, we will use Philip CFD Trader. It is ideal for all purpose trading platform for our CFD trader. And next for promotion, everyone loves promotion, everyone loves sale. We have a trade CME futures with Philip, and you can earn up to 700 ringgit. So you can trade CME futures like US index, gold, crude oil, and also cryptocurrency and earn up to 700 ringgit. This promotion is until 31st August 2025. So if you want to know more about this promotion, you can just screenshot, take a photo, and scan this QR code. And next, trade USGX Asian Index futures as low as 1.88 USD. This includes Singapore, China, Taiwan, Japan, Indonesia, and Vietnam market. And this promotion is until 30th September 2025. Next is trade Singapore share at 0.1% only. This is considered one of the lowest brokerage rate in Malaysia currently, and this promotion is until 15 July 2025. And before I pass to our speaker today, Mr. Lawrence Lee, I will give us a little introduction about Mr. Lawrence Lee. Uh, he is a He is the Chief Investment Officer at Continuum Alpha Wealth Management, where he leads the firm investment strategy and oversees its product platform for relationship manager and ultra high net worth link. He has a 15 years of experience across major asset classes with roles in both private wealth and institutional fund the management. So, Mr. Lawrence Lee also holds an honor degree in economics from National University of Singapore and is a CFA charter holder and certified financial risk management. So, We'll pass the floor to you, Mr. Lawrence Lee, so you can share your slide.
Okay, hi, good evening, everybody. Okay, good evening, everybody. I'm Lawrence. Thank you for taking the evening today to join me on this webinar. We'll be talking about CME futures today and how to navigate the inside strategy and how to actually trade and try to make money from it. Before we begin, a little bit of disclaimer and disclosure on my end. I work for Continental Alpha, which is an external asset manager licensed by the Monetary Authority of Singapore. So this presentation is not meant to be investment advice nor product recommendation. So the outline for today, I will start off with an introduction to what is interest rate and the US Treasury market, followed by explaining some important fundamental concept about bonds and interest rate. And to better understand what is CME futures, I will give a little bit of introduction to the classic Treasury and also micro Treasury futures. And then we'll move on to CME futures, which is the focus of the presentation today. And I'll talk a little bit about the current interest rate market outlook and lastly, how do we apply the U futures to some case studies. So first of all, we need to understand what are futures and why are futures advantageous. So futures is actually a type of financial derivative. The term derivative comes from the word derive. So it's actually a financial contract that derives its value from an underlying asset. So it can be a commodity, index, a stock, or a bond. So in today's case, we'll be actually focusing on the type of derivative that is futures. Other example of derivatives will be options, forwards, warrants, or even swaps. But the futures is actually just a subset of financial derivative. So what are
Mr.
some
Lawrence,
advantages?
hold on.
Yeah.
Are you sharing the slide?
Are you not able to see it?
We just see your file, but cannot see the slide.
Oh,
And
sorry.
try to. Okay.
Are you able to
All
see it
right.
now?
Yes, can see it. All right. Okay, you may continue.
Okay, apologies on that. So yeah, this was actually the Outlook agenda that I mentioned. And yeah, I was talking about futures being a subset of is a type of financial derivative. And today we're going to focus on CMEU futures. So the underlying asset is actually on interest rate itself. So what are some advantages of futures against other derivative? Number one, it is around the clock access. It's trading almost 23 hours a day. It's very transparent and low cost, and it's also designed to track the underlying efficiently. There's also efficiency of margin, meaning if you post a certain margin, you can actually take leverage exposure on it. It's more efficient on capital. And there's also no counterparty risk because essentially you are facing the exchange. So there's no risk of default by a counterparty. So these are some of the advantages of futures. So what is interest rate and who actually sets them? So we need to understand why interest rate is important. I think interest rate affects the economy in different way. On the individual level, it affects your saving rates, how much interest you get on your deposit. It also affects your housing loan rate. because that affects the mortgage that you pay monthly, car loans, etc. So typically when interest rate is high, it means the cost of borrowing money is more expensive. So people tend to spend less, and it affects the aggregate demand in the economy. For corporation, it's similar. It affects business decision, whether they want to invest in capital expenditure or hiring plan. Higher cost of borrowing for the corporates means they tend to pull back on those plans. For government, similarly, they have to issue bond to borrow money, and they borrow money to spend on infrastructure, on healthcare, etc. So when interest rate go up, it's also painful for government to borrow. And for financial asset, typically a higher interest rate means, because the value of financial asset is always the present value of future cash flow. So a higher interest rate tend to mean that this cash flows are discounted to be a lower present value. So it will affect valuation. So in 2022, when interest rate went higher, equity markets and all other financial assets value come down. And in terms of currency, typically a higher interest rate country will attract hot money because they get higher yield on the deposit. So typically that currency will tend to be stronger. So in aggregation, interest rate is important because through its various transmission mechanism, it affects the aggregate demand in the economy. So it's important to understand interest rate. We need to know who actually sets the most important interest rate in the world, which is the US dollar interest rate. It is actually the US Central Bank, otherwise known as the Federal Reserve System. They have a dual mandate, which is to try to maintain maximum employment and also price stability. And they are made up of three important key entities: the Federal Reserve Board of Governors, and they are made up of 12 Federal Reserve banks, and also the FOMC. So the FOMC is a committee that hosts the most important meeting in the world for monetary policy. They hold it 8 times a year, scheduled meetings, where they set the monetary policy and guidance. And the next Fed meeting, the next FOMC meeting, is actually on the 18th of June. So why is the US Fed so important? For two simple reasons. Number one, the US dollar is the reserve currency of the world, and the US is currently the biggest economy in the world. So whatever the US Fed says actually affects the entire economy in a big way. So the Fed will actually set a target range for the Fed fund rate. So it can be hawkish or dovish. Hawkish means that the signal interest rate is going higher, and dovish means the other way around, where they cut rates or signal that interest rate is going lower. And this actually affects the market interpretation, expectation of interest rate in the future, and it affects the current overall financial conditions in the market as well. And this has a knock-on effect on consumer and producer spending decision, and ultimately this have an effect on aggregate demand, and it actually affects the progress towards the dual mandate of maximum employment and price stability. So we know Trump, this year is all about Trump and tariff. This is tariff 2.0. We all know 2nd April will go down in history as the Liberation Day, where we don't feel so liberated because it sets off a lot of shockwave through the economy and financial market. You can see this is the S&P chart, how it actually tanked in a matter of days as Trump announced its reciprocal tariff, only to announce 7 days later that it will have a 90-day pause, and market has recovered, S&P has recovered all the way back to 6,000. But as of this morning, Trump again has injected volatility by saying that in the next 2 weeks, which is before the 90-day pause, that is going to reintroduce a potential new reciprocal tariff. So why is US interest rate important? Is because the 10-year Treasury yields have also been very volatile. As some of you might know, US Treasuries are supposed to be a flight to quality safe haven, meaning in periods of uncertainty, people tend to buy US Treasury because it's supposed to be the highest grade and most liquid, and is backed by the full faith and credit of the US government. So it is supposed to be a safe haven quality that you expect when the Liberation Day kind of day, the Treasury yield is supposed to come down. But that is not the case lately. You can see when Liberation Day hit, Treasury yields actually came lower, only to reverse in a matter of days, going up by 50 to 60 basis points from the low, as markets start to digest what Trump tariff actually can mean. And then it actually stabilized before the Treasury yield started going higher again in May, as markets start to be concerned about Trump's latest, they call it the triple B bill, the one big beautiful bill, which is projected to add about 2.4 trillion of spending to the deficit. So people start to be concerned whether uh, US can continue to be exceptional. There's concern that US dollar will start to lose its value because of Trump's hazard policy. So you can see that the treasury yields have been very, very volatile in over the last 2 months. And why is US Treasury bond market important? There's a lot of talks as to why Trump actually had a 90-day truce where he postponed the reciprocal tariff by 90 days. And I think the consensus is it was because he was worried about the impact of the bond market. So these are some of the headline news. We can see that Trump actually chickened out because of what the treasury market was signaling to him. Because equity markets can fall, but it won't affect the every American, because not every American own equities, but every American has a housing loan to pay. Every American has a credit card loan to pay. So as interest rate went crazy, uh, the political capital of Trump was also eroded. So he actually blinked because the treasury market forced him to capitulate. So that was the general understanding why he reversed the reciprocal tariff only 7 days after announcing them. So what is the US Treasury market? It is actually the largest and most liquid interest rate bond market in the world. Currently, there's 29 trillion of total outstanding issuance, and that is a staggering amount. It can be issued via auctions on primary market, and secondary market is where they are bought and sold and traded thereafter issuance. And as mentioned earlier, US Treasuries are deemed to be a safe haven or flight to quality instrument for many, many years, until lately that has been called into question. So for US, this is very often talked about now in financial market, is that the US public debt has hit a record 36 trillion, and it is projected to continue increasing with fiscal deficit widening. This debt to GDP now is at 120% and is projected to hit 160% in a few years' time. So this path is very explosive and unsustainable. So how staggering is a debt of US 36 trillion? In actual number, it is approximately the value of these 5 countries combined together. And it is actually about 107,000 per person or 274,000 per household. So it is a very, very colossal amount of money we're talking about. So for US Treasury auction, which is the primary market, because they need that amount of debt, they keep rolling their debt because they have to keep financing and issuing more debt to finance their spending. So this table shows you the schedule of the treasury auction, very regular. On the run means treasuries that are most recently issued, and off the run, because the issue is so regularly every month, what is issued last month will become off the run in a month's time. And treasuries are divided into bills, notes, and bonds. So typically below 1 year, we call them treasury T-bills. Notes is up to 10 years, and bonds will be 20 years and above. So there's also something known as the term structure, which actually means the yield curve. So the yield curve actually reflects market expectation about the future changes in interest rate and monetary policy condition. So curve can be upward sloping, downward sloping, or flat, or even inverted. So last year when I was doing this presentation, the curve was actually inverted, meaning the yields are higher at the front end and the yields were lower at the long end. So the curve was inverted because front end yields were higher than long end yields. But fast forward 1 year, the Fed has started to cut rate last September. The front end yields has come down and the long end yields have actually picked up because of worry about the US fiscal and inflation situation. So you can see this yield curve is very dynamic. It can keep changing and it reflects the market interpretation of what future interest rates should be. So we are now moving on to some very important fundamental bond concept, and it's a little bit technical, but we have to understand them for you to be able to trade and understand your risk better. So we often heard that there's an inverse relationship between bond prices and yield, i.e. people always tell you when interest rates go up, bond price tend to come down and vice versa. So why is this so? So mathematically, it can be explained very simply because if you look at this formula, the price of a bond is actually the present value, i.e. you discount the future expected cash flow back to current. So in a bond, you expect to receive periodic coupon and your principal at the end. And this, you have to discount it by the interest rate. So mathematically, as the denominator interest rate goes higher, you would expect the overall to actually be lower. So present value of the future cash flow will become smaller when interest rate go higher and vice versa. So when interest rate is higher, the price of bond is lower. There's an inverse relationship between the two, and it's a very important concept to understand. The next important concept in interest rate is the concept of duration. So what is duration? Duration in English, it means the time and the length. But in bond terms, it is similar, but it has a connotation of actually a risk measure. It measures the sensitivity of a bond, the price change to interest rate change. So how much will a bond price change when interest rate changes? So it's not exactly the same as a bond term to maturity. So if you buy a 5-year bond, it doesn't mean duration is 5 year. It is close, but it's not exactly close because it can be affected by maturity, yield, and coupon. But by and large, the higher the duration, the more sensitive the bond is to interest rate changes and is more prone to interest rate risk. So it's more sensitive to a change in interest rate. So if you look at the 2-year, 10-year, and 30-year bond, you can see that the duration is 1.85, 7.95, and 16.5 respectively. So for a 1% move higher in interest rate, you can see that the bond price change is also different. It is the least sensitive for a 2-year bond and the most sensitive is actually the 30-year bond, which is what we come to expect from duration. So very closely related to the concept of duration is something known as DVO1, which is the dollar value per 1 basis point change. So what is a basis point in the fixed income world? So in 1 percentage point, there's 100 basis point. So 1 basis point is actually 0.01. So DVO1 is defined as the change in the price of a bond for every 1 basis point change in interest rate. So unlike equity, in interest rate, we talk in terms of basis point change. Every change is very minute. We don't talk in percentage move like in equities because in interest rate, every 1 basis point is also very significant. So if we look at a 10-year US Treasury note, this example is the 4% February 2034 note. The last price is 95-17. So in Treasury market is always quoted in fraction. So 95-17 means 17 over 32. 17 divided by 32. So the price of the bond is 95.53125. So for this bond, the modified duration is 7.95. The yield is currently 4.57. It means the cash price, if you were to buy it for 100,000 face value, you actually have to spend 95,531.25 for it. So how do you calculate a DVO1? it actually means you simulate moving the basis point down by 1. You expect the price to go up. The absolute price change is 76.39. And if the interest rate is to go up by 1 basis point to 4.58, you expect the price to come down by 76.32. Then to calculate a DVO1, we actually take the absolute sum of this change and divide by 2. That gives you 76.36. So this is the absolute DVO1. But of course, in today's world with financial terminals and internet, you're able to get this DVO1 fairly quickly. But this is the theoretical explanation behind it. So the modified duration is actually a faster way to get it. Is actually the modified duration multiplied by the price and the 1 basis point change. So 75.95 is the DVO1 example here. So in general, we can say that the longer the maturity of the bond, the greater the duration risk and the price sensitivity to a change in interest rate, and the larger the DVO1. So earlier, you can expect the DVO1 of a 30-year bond to be larger than that of a 2-year bond. So now we're going to move on from fundamental bond interest rate concept to US Treasury futures. So who use US Treasury futures in the portfolio, and how do they use them? So for portfolio managers or even individuals who hold a portfolio of bond, they can very quickly use Treasury futures to adjust the portfolio duration. So for example, if I'm holding a lot of bond, corporate bond, high yield bonds in my own portfolio, and I see that the Fed could be hiking interest rate very quickly, but I do not wish to sell my bond, I can actually use futures to immunize my portfolio or to hedge the duration risk of my portfolio. Similarly, I may be somebody that currently don't hold anything, but I think that the Fed might cut rates or they might hike rates or what, and I can actually just go into a Treasury futures to express that view very quickly. I don't have to worry about using actual cash to buy the bond or to repo the bond, etc. I can also use Treasury futures very quickly to put on a curve trade. If I have a view on the slope of the curve, either it will steepen or flatten, and this is something I will talk about later on in the presentation itself. So to understand futures, we need to understand the grandfather of Treasury futures, otherwise known as the classic Treasury futures. So these are the futures that institution people like hedge fund managers, pension fund, asset manager, and when I was trading for a bank, I actually trade this US Treasury futures classic a lot because it's the most liquid and it actually represents the entire spectrum of the US Treasury market all the way from 2-year to 30-year bond. They have different face amount depending on the maturity. And if you can notice, let's say we take a look at the 10-year note, there's deliverable maturity from 6.5 to 8 years. I'll explain that later. Contract month, there are 4 quarterly contract, March, June, September, and December, and they keep rolling. There's also the tick value, and all these are on the CME website if you want to know in greater detail. So there is a concept of cheapest to deliver for this Treasury Classic futures because there's actually physical settlement. So if you are short this Treasury Classic futures, you need to choose when to deliver and what eligible security to deliver to the holder or the long or the buyer of the Treasury futures contract. So you will always choose the cheapest to deliver bond. And what is the cheapest to deliver bond? It is the bond with the highest implied repo rate. So what does this mean? It means if I were to go to a market, I buy the cash bond, I sell the futures contract to hedge against it, and I take this cash bond, I lend it in the repo market. It is supposed to be the bond that gives me the highest implied repo rate. So it's a bit theoretical. I'm not going to go into detail here, but majority of the traders like myself or people who hedge, we don't go all the way to delivery because it's very troublesome. You need to, if you are short, I need to make sure I have the bond to deliver. If I'm long, I need to take ownership of the bond, which is maybe not what we want to do when we go into futures trading because we might just want to hedge or to do a for simple P&L gain. So this is taken off Bloomberg. you look at this is a TYM5 commodity. It means this is the 10-year June 2025 futures contract. So earlier I mentioned there is a March, June, September, and December contract. They are named differently. M stands for June, H stands for March, U stands for September, and Z stands for December. So now we are actually trading the active month contract, which is June. So this is TYM5. So this is a cheapest to deliver table. You can see that this particular bond, because it has the highest implied repo rate, this will be the cheapest to deliver security. So earlier we talked about calculating the DVO1 of a treasury bond. Now, how do we calculate the DVO1 of a treasury futures contract? It is very similar, just that we have to divide the cash bond DVO1 by a conversion factor. So what is this conversion factor? Do note that earlier I mentioned there's a range of deliverable maturities for the futures contract. There's a range of bond, and we always choose the cheapest to deliver security. So we actually need to standardize this because the price of a treasury futures contract is different from the price of the underlying bond. There's actually a concept known as a conversion factor, which equalize all the coupon and accrued interest. And because it assumes a 6% yield to maturity, the conversion factor will be lower than 1 if the coupon is less than 6%. And most of the bonds that are issued are actually lower than 6% coupon. So you can see that the conversion factor are all below 1 now. So simply we take the cash bond DVO1 divide by the conversion factor, we can get the futures DVO1. So now we'll do a very quick case study. It's not the most important thing today, but it will help you appreciate what yield futures are about later. So this is a case study using the classic treasury futures. So the trader believed the US economy will keep strengthening and the 10-year yields will rise. So to express his view, do note that there's an inverse price and yield relationship. So for yields to go higher, they must sell the treasury bond futures. So he go ahead and he sold 10 contract of the June 2025 10-year T-note at 110-14. So remember, this is quoted over 32. So this means it's 110-14 divided by 32. His view was correct. The price went down, yields went higher. He bought back the TYM4 note at a price of 109-16 over 32. I highlight the big figure in yellow because the big figure actually changed. So it actually dropped 14 and then it crosses the big figure to 109 and then it dropped another 16 ticks. So the dollar value for the minimum tick is 15.625 per tick, and the actual move here is actually 30 times 2, which is 60 ticks. So the actual P&L of this trade is 10 contract times the number of ticks and the dollar value for the minimum tick, you get 9,375. So you can see it's a little bit complex. Number one, you got to understand that it trades in an inverse relationship. Number two, it trades over 32 and different contracts. Some are 15.625, some are not, depending on the maturity you trade. So it gets a little bit confusing. So it's actually meant more for institutional traders. So CME actually introduced another thing called the CME Micro Treasury Futures. The difference between this and a classic is still quoted in 30 seconds. It is still an inverse price yield relationship. The difference between the Treasury Futures Classic, which is what institution people use, and the Micro Treasury Futures, which was what was introduced for retail, is that the micro treasury futures are cash settled, not physical settled. So you don't have to worry about the cheaper to deliver, about the operational issue of taking delivery. And that is the one of the most important difference. The second important difference is only available in 10-year and 30-year, so it's not available in 2, 3, 5 maturity. And why is it called micro? Because it's micro. It's actually 1/10 the size of the classic treasury futures. However, CME still feel that this is not retail enough, not friendly enough for retail client because it's still trading in 30 seconds. It is still trading in an inverse price yield relationship. So they actually introduced something called the CME U futures, which is what we are going to go into in depth for this presentation. So what are CME U futures? Number one, they trade in U rather than price. So always last time you have to think in terms of an inverse relationship. If you think interest rate is going higher, it means price is coming lower. It is not that intuitive because you will need to short the bond when you think the interest rate is going higher. So now for CME futures, they is not traded in the inverse relationship. If you think U are going higher, it's straightforward. You buy it. If you think the U's are coming lower, you sell the futures. So it's very straightforward. It carry on the benefit of the micro treasury futures in that it's cash settled. There's no need to worry about cheaper to deliver, etc., because there's no physical settlement. There's no operational risk of physical delivery. And I think the most important thing is it is also very small size. It's very friendly for retail. Want to try to trade interest rate. The minimum price increment is 1/10 of a basis point. So a basis point is already very small. So they even trade to zero point 0.1 of a basis point. And one basis point is actually $10. So we're talking about very, very granular kind of movement. And instead of the micro treasury futures or the classic treasury futures, which has a basket of deliverable securities, they only have one on the run security. And lastly, there is a constant risk exposure and duration, which I will explain later, of $10 per DVO1. So it doesn't matter whether you trade a 2-year, 3-year, 5-year, 10-year, 30-year U futures, it is set at $10 DVO1 regardless of duration. So it is actually very clean, unlike the classic treasury futures where the DVO1 is not constant, it keeps changing because of different notional values and price. So this is the contract specification for CME U futures. You can get this from the CME website as well. They follow the broker tag US Treasury benchmark. So this is also available on the CME website. You can see 2-year all the way to 30-year single security with the U all published on the CME website. So this is the DVO1 I talk about. So the light blue bars represent the classic treasury futures or the micro treasury futures where DVO1 are not constant. The longer the maturity, we expect a higher DVO1. But for U futures, they have standardized it. They have kept DVO1 constant. And so it's a lot cleaner for your calculation and to understand your risk. So some question some people might have, if you look at the broker tag, these are the on-the-run treasury yield. So 2-year is at 3.935, 10-year at 4.42. So those are the actual cash bond, cash treasury that are trading. So the question is, how do I know whether the U futures that I see is lower or higher? So to understand all future derivative, it's a very simple concept of spot versus futures. The difference is actually the cost of carry. So if the cost of carry is positive, then you can expect your cost of spot plus cost of carry equal to the price of your futures to be higher. So if your cost of carry is negative, you can expect your futures to be lower than your spot. So if you look at example, if the 1 month SOFR, which is the borrowing cost, is 5.31 and the 10-year note is at 4.5, so the financing cost is actually higher than the on-the-run yield. So the carry is actually negative. So for this case, I will expect the futures price that I'm seeing to be lower than the on-the-run price. So if the on-the-run price is 4.57, then I will expect the futures price to be 4.56. So a very quick diagram to show the difference. Number one, 10-year U futures, they are traded in U. classic futures are traded in price. Number two, they are cash settled. So there's no inverse relationship to worry about. Cash settled, so there's no delivery to worry about. Most importantly, they have a constant DVO1 of $10 regardless of tenor, whereas the DVO1 of the classic futures are subject to changes. Very, very small tick size, traded to 1/10 of 1 basis point. Yep, so these are the important differences between the U futures compared to the classic. So before we go into the case study, let me quickly talk about the classic, the current market and interest rate outlook. So the whole world has been going through a disinflation trend over the last 2 years. This is what we built in-house to monitor the inflation trend. So if it's red, it means the current inflation for the country is above the central bank target, and if it's blue, it means it's below. So over the last 2 years, we can see that the whole world has gone through a very, very good disinflation cycle, all nearing, most of the countries are trading below the central bank target, except United States is less red, but it is not blue yet. So the US CPI is encouraging or late. In fact, last night, CPI was also lower than expected. So it is a good sign. If you look at the Fed's preferred measure of the core CPI, it's also nearing the Fed's target of 2%. The current core CPI is about 2.3, 2.4 level. So this means that it's actually nearing the Fed target. Market should be happy because the Fed has a dual mandate of unemployment and inflation, and we are nearing the inflation target, means they should be able to lower rates soon. However, they are not currently rushing into cutting rate. Why? Because this imposition of tariff 2.0 could threaten to bring inflation back 1980 style. So in the 1970 and 80, the Fed cut rates maybe too prematurely, and inflation shot all the way back up to 15-16%. And Paul Volcker in 1980 was forced to hike interest rate very rapidly to combat the high inflation. So if we look at 2013, which is the light blue line, if we look at 2013 to current, we superimpose over the 1965 to 1985 inflation trend. It is very eerily similar, and there's a worry that this tariff 2.0 can bring back inflation like the 1980s. In that case, the inflation interest rate will probably continue to stay high. And worrying, the US retail sales has also been weaker than expected lately. The US consumer are also turning more negative. They are expecting higher inflation expectation, and their consumer sentiment is also worsening in the last couple of months. So this is actually a very stagflation kind of scenario where you are weakening growth and higher inflation. And the US economy is, a year back, people are talking about US economy is Goldilocks, equity can continue to go higher. But then growth started to slow. It started to, from Goldilocks, we go to stagnation. And now potentially we have a problem of stagflation. The non-farm payroll has steadily also been weakening over the last 2 years. So we might be really staring at a situation of stagflation. The US rate cut pricing have also been very volatile. So if you look at 3 months ago pricing, represented by the gray bars, to the current red bar, you can see that because the Fed has come out and said they're going to be a more wait and see approach, because they are also uncertain about how tariff is going to affect inflation. A lot of this pricing have been pushed out to 2026 because market is uncertain. So you can see that the current rate bar is only pricing in slightly more than 2 cuts this year, whereas at the peak this year, it was pricing up to 4 cuts by the end of this year. So a lot of these rate cuts have been pushed out to 2026. And this is a chart of the Fed fund rate. You can see in 2022, they were forced to hike interest rate all the way up because inflation was at 9%. But last year, as inflation started to slow, they also have started cutting rates last September. But now, market initially expected them to cut rates more. This represented by the yellow line. But now market is slowly converging to what the Fed is projecting. Fed is going to give their dot projection in 2 weeks' time, and we shall see whether it's more aligned with the market. CME has an interesting tool on their website. It's also free. Google CME Fed Watch tool. You can see what market participants are expecting. So currently, market is expecting that there's a 95% chance that Fed does nothing in the 18th of June meeting because they're taking a wait and see approach to incoming data. So I'm going to go through 3 hypothetical case study of how we can use the CME futures to trade around a bearish case, a bullish case, and also a curve trade. So number one, like I mentioned earlier, for many years until the last 2 months, there were no question that US Treasuries are considered as the safest haven in the world, most liquid and flight to quality instrument. So in time of crisis, like a Ukraine-Russian war, Fukushima incident, or a big stock market sell-off, market generally will rush to buy US Treasury and gold as a safe haven hedge. Why? Because they think that in any case, it's the safest instrument to hold, and usually in a risk-off environment, people expect the Fed to cut rates to stimulate the economy. So this flight to quality buying will usually result in higher treasury bond prices and lower yield, the inverse relationship that we have been talking about. So this case study, last year, 19 April, the trader believed that the Iran-Israel geopolitical tension will worsen. So to express his view, because he thinks it will worsen, he thinks that the yields are coming lower. In a CME yield futures, if you think that the yields are coming lower, you sell it because there's no inverse relationship. It's a straightforward relationship. And hours later, Israel struck Iran with some airstrike. Risk-off event happened and expected US Treasuries, gold, oil all soared in prices. So the CME 10-year yield futures yields sank. The Treasury bond price rose. So the trader actually managed to buy back these 10-year yield futures at a lower level. So earlier we mentioned the DVO1 of the 10-year CME yield futures is at $10. So the number of basis points made on this trade is to the third decimal point. It's actually 11.2 basis points. So very easily you can calculate the profit you make is the number of basis points times the DVO1 and the number of contract. So for this trade, the trader, because he has 100 contract, he make $11,200. So this is actually the actual case study. He sold the contract at 4.624. He bought back at 4.512. So this is case study 1. Now, case study 2 is the other scenario where it's actually a hawkish repricing of the Fed. So as mentioned at the start of the presentation, the Fed has a dual mandate. Number one, to maintain price stability, i.e. to manage inflation. So if inflation prints are hot, meaning they are higher than expected and higher than their target of 2%, market will expect the Fed to become more hawkish, so pricing less probability of cut, or even if inflation is to go through the roof, they might be forced to bring interest rate higher. So this will typically result in a lower US Treasury bond price and higher yield. So on 10 April, before the US CPI, this trader believed that inflation will be higher than what market expect. So he expects yields to go higher. So in the case of yield futures, he will go and buy because he thinks it's going higher. He bought 85 contract of the 2-year, and as expected, the CPI came in stronger. So the yields actually went higher. So this trader actually make a profit. He sold it back at 4.93. And notice that regardless of whether it's 2-year or 10-year yield futures, the DVO1 is the same at $10. He made 17.8 basis points from this trade. So 85 contract multiplied by the number of basis points and the constant DVO1 of $10, he made $15,130. So this is the actual case study. He bought it here, CPI came in hotter, and he took profit here. Very simple trade. The last 2 case study, I'll be talking about curve trade. So you do hear a lot of terms. Sometimes you read newspaper, financial magazine of yield curve, steepening or flattening. So those are example of curve trade. it is good for investor who sometimes, taking outright directional risk can be risky. They want to take a curve trade. So usually curve trade are structured to be DVO1 neutral. So you are long one and you are short the other. You cancel out the DVO1. So yield curve is either steepener or flattener. They will only make money or lose money when the shape of the yield curve change. So in a case where the yield curve move parallel, meaning that the shape of the curve don't change, it did not flatten or it did not steepen, such a parallel shift, there will be no profit and loss. So yield curve steepener means that investor expect the long end yield to rise faster or fall slower than short end yields. So you can sell long end bond and buy short end bond. Or in a case of yield future, it's straightforward. If you think that it's going to steepen, you buy the 30-year future, you sell the 2-year yield futures. So vice versa, yield curve flattener means that the investor expect the long end yields to rise slower or to fall faster than the short end yields. So in the bond terms, you buy long end 30-year bond and you sell short end treasury bond 2-year. But again, in yield futures, there's no inverse relationship to worry about. If you think that curve is going to flatten this way, you sell the 30-year futures and you buy the 2-year yield futures. So there are 4 different kinds of yield curve regime: bull flattening or bear flattening. So a bull flattening case will happen when, like the Iran case, is a risk-off event. People will usually rush to buy the long end bond. So the long end yields will tend to flatten faster than the short end yield. A bear flattening case can happen usually in a rate hike scenario because the Fed will start to hike front end rates faster. So it result in a curve sometimes being flat or inverted. So that's known as bear flattening. Similarly, what is known as bear steepening is when the long end yields actually move faster than the front end yield. And this is actually what we are witnessing in the current market now. The US curve is actually bear steepening because of fiscal worry, inflation worry, so it's steepening a lot faster than the front end yield. And a bull steepening can happen when the Fed is cutting interest rate. So as they cut, the front end yields will drop faster compared to the long end yield. That will cause the curve to steepen in the bull steepening manner. So these are the 4 different kinds of yield curve regime. So this is the last case study we're going to go through. It's a yield curve steepener. As mentioned earlier, US debt 36 trillion, debt to GDP 100, above 100%. Fiscal deficit expected to be 7.1% in 2025. And the way they are paying net interest payment on, the net interest on their debt is also at a staggering amount of 880 billion a year. It's not sustainable. So we can expect that the US term premium to continue to increase with the long end bond yields expected to rise faster and faster. So to express this view, the trader actually, so he thinks that the curve is going to steepen. So what does he do? He actually, in a yield futures context, simple, he buy the 30-year yield because he thinks it's going higher, and he actually sell the 2-year yield futures. So remember I said in curve trade, people always set it to be DVO1 neutral. So in terms of yield futures, it's very simple because the DVO1 of a 2-year and the DVO1 of a 30-year is constant at $10. So if you buy 100 contract of 30-year yield futures, you just have to sell 100 contract of 2-year yield futures. Your DVO1 will be netted. So in the case of this, when he went into the trade, the curve was actually inverted at negative 0.216, means the 2-year yield futures were higher. But when he took out the trade, the curve has actually steepened by a staggering 32.9 basis points. So the 30-year yield has gone up much faster than the 2-year yield. So this is a case of a bear steepening. So you can calculate the P&L individually by the 2-year leg and the 30-year, you take the difference. Or you can very simply, because the DVO1 are the same, just take the number of contract you have, 100, times the absolute change in the yield, which is 32.9 here, and the constant DVO1 of $10, and you get $32,900 from this curve steepener trade. So this is a diagram I used from last year. You can see that it was actually inverted And now this value is actually somewhere here because the curve has steepened up so much. So the last case study, U curve flattener. Similarly, I explained earlier there's bull flattener and bear flattener. So this trader now believes that incoming employment and inflation data will be stronger. So it's a case of a bear flattener trade. So to express this trade, he simply buy the 2-year U futures and he sell the 10-year U futures. So similarly, the curve you can notice from negative 0.216%, it actually flattened further by 12.6 basis point to negative 0.342 because you can see that the 2-year U gone up much faster than the 10-year U, 17 compared to 4.5. So the difference between the two is 12.6. So you can see the curve has actually bear flattened. Similarly, very easy to calculate. 100 contract times the difference, how much the curve has flattened, 12.6 basis point, $10 DVO1. And that's the actual P&L. So again, this curve used from last year, but actually now it has steepened out a lot. So CME has also a free tool you can use called the CME Curve Watch. You can Google this. Go online, you can actually have all the current curve trade value, etc. So with this, I've come to the end of my presentation. Happy to take some question and answer now.
All right. So if you have any question, can you just drop by on the question box. So I think we wait for 1 minute if they got question. So everyone can hold tight because after this we have a question and reward. So which I will ask two questions. So the correct answer and fastest answer will get 20 ringgit touch and go reload pin. Mm. So I think there are no question from the audience. Okay, I will proceed for the quiz reward. So the rules is simple. There will be two questions. So the fastest and correct answer will get 20 ringgit touch and go reload pin. All right, get ready. So the first question is, what is or how much the DVO1 of 10-year CME yield future? So you can answer at in the chat. All right, I already see the winner. It is Richie C. So the person in charge will contact you and you will receive the reward in few days. Right. All right. For the second question is, if you believe interest rate to be going higher, should you buy or sell the yield futures? All right. I already saw the winner is Chiu Chin Hang. Congrats, Chiu Chin Hang. Person in charge will contact you and you will receive the touch and go reload pin in few days. Okay. All right. Thank you, Mr. Lawrence, for this very insightful share about the yield feature.
Okay, thank you everybody.
Uh,
Thank you, Ayman.
all right. So share. So we pass our Q&A session. Congrats to the winners. So if you're interested to open an account with Phillip Capital or stock or futures, you can scan the QR code, take a picture or screenshot for your reference, and we'll bring you to our website to online account opening. So you also can contact us through our social media and also website. You can follow our social media, Facebook, YouTube, LinkedIn, and TikTok, and also Instagram. So you can join our Telegram channel. The above one is for our stock channel, and the bottom one is for the futures and CFD channel. So you may take a screenshot and take the picture to join the Telegram channel. All right. So if you want to visit our branch, you can contact us or email us for to visit our PIC branch around Malaysia. Okay. Thank you for joining the webinar tonight. CME Micro Treasury Yields Futures, Insight Strategy and Trading Dynamics. Thank you to Mr. Lawrence for very insightful share. So that is all for today's webinar. Have a good night.
Thank you.